A second wave of inflation has begun. There's going to be another inflation wave, similar to what happened in the 1970s. We have the same playbook in front of us. What playbook is this then? What trends in money printing in 2020 can we examine to predict future developments? We must first examine what got underway in 2020. In March 2020, the money printing process commenced. At the same time, asset prices began their unprecedented upward trend. However, it took until March of 2021, a year later, for the prices of goods and services to even return to their prior average of 2.6%. And then, in June of 22, they at last shot up to their most recent and historic highs. Around that time, the Federal Reserve began to tighten in an attempt to rein in inflation, because they were afraid it would just run away from them. They started to increase interest rates and shrink their balance sheet. The pace of inflation also began to decline in lockstep. Not prices, only the inflation rate. Nevertheless, the person who accrued the greatest debt is under pressure each time this cycle is completed. That's the U.S. government in this instance. The amount of additional debt owed by the federal government increased to an unprecedented level. To inject capital into the economy, they borrowed an enormous sum of money. Furthermore, they were taking out loans at historically low interest rates, which were almost nil. Because the debt is low right now, that gives false confidence. However, what occurs if the debt increases in the future and you need to take out further loans to pay off the previous debt? The federal government is currently rolling over a large amount of that previously inexpensive debt at rates they can hardly afford as a result of inflation persisting over the Fed's objective, and them having to maintain historically high interest rates to carry on trying to battle inflation. This implies that if the pressure increases, they will either have to default or the Fed will intervene and provide them with relief. Lowering interest rates has been the method used in the past to accomplish this relaxing once things start to pick up again. As you can see, they caused inflation to spike twice in the 1970s by doing this. They're not going to decrease interest rates this time to lessen the burden on the government, and I'll explain why later. They intend to use debt monetization this time to achieve that goal. Put another way, creating money to lend to the government or engaging in quantitative easing. As a result, the Federal Reserve's balance sheet will increase, enabling the government to keep taking on more and more debt. The additional money they will be injecting into the economy will cause the rate of inflation to rise once more. This indicates that despite slightly different causes, the rate of inflation is currently following the same trajectory as it did in the 1970s, and this is already beginning to happen in real time. Recall that asset values in 2020 anticipated future inflation and began to soar before the inflation struck goods and services. This is currently taking place and is referred to as the Cantillon effect. Gold has reached all-time highs after emerging from a multi-year consolidation pattern. Silver is moving much higher after breaking out of a multi-year consolidation pattern. Additionally, it appears that Bitcoin is set to rise significantly since it is currently consolidating around all-time highs and a bull flag pattern. The S&P 500 and other stock market indices are likewise at record highs. We could continue endlessly. The truth is that asset prices are detecting something. As of right now, there are a ton of chances to profit from this, both in the short and long term. Because of the asymmetric nature of these possibilities, the maximum amount you may lose is considerably less than the maximum amount you could gain. I just emailed an asymmetric opportunity notice to Heresy Financial University members on GDX, an ETF for gold miners. Even though the move is just getting started, GDX has already increased by 27% from when it was selling at about $26 per share. One simple thing I do for members of Heresy Financial University that can bring them a ton of money is receiving reports of asymmetric chances, like this one. However, if you're eager to discover how to accomplish this on your own, please note the following date on your calendar. At 7:00 p.m. Eastern Time on April 25, I'll be discussing the asymmetric trade, which is one of the best-kept secrets in finance, in a live masterclass that I'm conducting. For some of the largest investors and traders in recent memory, like Ray Dalio, Jim Rogers, Bill Ackman, and Martin Burry, these kinds of asymmetric transactions constitute their source of wealth. Over the past 8 months, I have been testing and utilizing this method in my account to generate some significant profits. I'm going to impart all of my knowledge to you. You won't want to miss it because it's free, especially given the uncertainty surrounding this year's elections, changes in interest rate policy, and global unpredictability. All you need to do is enter your email and click the link in the description below. I'll see you there. Therefore, the current pattern is the same as what occurred in the 1970s, when the rate of inflation rose until authorities began to clamp down on it, after which it fell that caused other issues that needed to be addressed with further easing, which in turn caused inflation to rise again. However, I can tell you're not persuaded. You sit there believing that everything is perfect, that Myomics is doing great, that I'm making excellent money, that everyone I know is making good money, and so on. Yes, there has been a slight stalling of inflation, but it will continue to decline, and the job market is fantastic. What could be the root cause of an inflationary spiral so severe that it would lead to increased money printing? Well, disregard all of that. The market wouldn't be expecting the Federal Reserve to lower rates anytime soon if that were the case, and the market believes that the Fed will lower interest rates. Not so quickly. If you've been following me for any length of time, you are aware that I have long maintained that the Federal Reserve will not be reducing interest rates in the manner that the market anticipates. The Federal Reserve was expected to cut interest rates significantly by the market last year, but in many cases, not only has that not happened yet, but the situation has suddenly shifted. Powell recently discussed the strategy the Federal Reserve is using to combat inflation, and reiterated that the best course of action is to wait and see. A few days later, Barkin from the Federal Reserve came out and stated, "We need confidence in the path of inflation moving lower to be able to cut rates," which serves to further emphasize this point. To emphasize the point even further, Kashkari of the Federal Reserve stated the next day that he would doubt if any rate cuts would take place at all if inflation continued to move sideways rather than downward. Additionally, that, as I mentioned earlier, the Federal Reserve is afraid that this will happen, repeating the 1970s playbook in which rate cuts in the early and mid-1970s led to a fresh upsurge in inflation, which is why they are not going to lower rates this time to relieve pressure on the largest borrower. However, just because they won't make the same mistake with interest rates doesn't mean they won't find another way to feed inflation. The federal government is currently carrying a massive $34 trillion debt load, which they must pay off daily at interest rates that are significantly higher than when they were first borrowed. They will need to take on more than $10 trillion in debt this year alone, all at historically high interest rates. Due to this, the interest paid on the national debt loan is now one of the largest budgetary items. It has surpassed $1 trillion already. The Federal Reserve will have to intervene and act as the government's lender of last resort when the chips are down. There won't be anyone left in the system to lend to at rates they can afford once they've drained it out of its liquidity. To purchase that debt, the Federal Reserve will intervene and create new money. Put differently, acts as the government's indirect lender via the banking sector. They will expand their balance sheet once more, and prices will rise as a result of the government receiving fresh funding to be invested in the economy. The most important thing to remember is that asset prices are already factoring this in, with the price of gold, Bitcoin, and the stock market all record highs. Furthermore, by refusing to cut interest rates for individuals like me, the Federal Reserve will exert even more pressure on the economy in an attempt to curb the inflation of goods and services. This implies that the economy will continue to pay higher and higher prices for debt in addition to paying higher and higher prices for assets, goods, and services. The Federal Reserve has already given the market a hint as to what its intentions are: to maintain high interest rates while continuing to stoke the fire with additional employment creation. Additionally, remember to use the link in the description to register for my masterclass on asymmetric trading. You don't want to pass up the opportunity to discover how to profit from all the strange events that are occurring this year. Thank you so much for watching as usual. I hope you have an amazing day.